Imagine the government as a very large household. It needs money to function, to build roads, to run schools, to provide healthcare. This money is its revenue. For a long time, governments around the world, including in Pakistan, had very simple ways of counting this money. They often just recorded it when the cash arrived. This method doesn't give a full or accurate picture of financial health. It's like only counting the money in your wallet but ignoring the salary you've earned but haven't received yet. This is where the International Public Sector Accounting Standards, Ipsas, come in, specifically Ipsas 23, which focuses on revenue from non-exchange transactions. Ipsas 23 provides a clear set of rules on how and when to record revenue. Its main purpose is to bring more clarity, consistency, transparency to public finances. Think of it as a universal language for government accounting. When everyone follows the same rules, it's easier to compare financial information, hold officials accountable, and make better decisions. To understand Ipsas 23, we first need to grasp the concept of non-exchange transactions. This might sound technical, but the idea is quite simple. A non-exchange transaction is one where a government entity receives value from another entity without directly giving approximately equal value in return. The most common examples are taxes and transfers. When you pay your income tax, you don't receive a specific direct service of the same value back from the government. Instead, your money is pooled with others to fund public services for everyone. This is very different from an exchange transaction, like buying a train ticket, where you pay a price and receive a specific service in return. Ipsas 23 is designed specifically to govern these non-exchange revenues. This is because they form the vast majority of a government's income. Think about it. The Pakistani government's budget is primarily funded by taxes collected by the Federal Board of Revenue, grants from international partners, transfers between different levels of government. These are all non-exchange transactions. Before Ipsas 23, there was no single clear rule on when to record this income. Should it be when the tax law is passed, when the citizen files their tax return, or only when the cash is finally collected? This ambiguity could lead to inconsistent and misleading financial reports. Ipsas 23 lays out specific criteria for recognizing revenue from non-exchange transactions. The primary rule is that an entity recognizes an asset, like a receivable, when a taxable event occurs, and the asset can be measured reliably. A taxable event is the specific activity or circumstance that the government has decided to tax. For example, the taxable event for sales tax is the sale of goods. The moment that sale happens, the government has a claim to the tax revenue, even if the business hasn't paid it yet. This creates a receivable on the government's books, providing a more accurate picture of the resources it is owed. The standard further breaks down non-exchange revenue into two main categories: taxes and transfers. Taxes, transfers. For taxes, recognition depends on the nature of the tax. Income tax revenue is recognized when the income is earned by the taxpayer. Value-added tax or general sales tax is recognized when the taxable supply of goods or services occurs. Property tax revenue is recognized when the government formally levies the tax on the property owner. Ipsas 23 requires governments to have systems in place to reliably estimate the revenue from these taxable events, even if the exact amount isn't known until a tax return is filed later. For transfers, which include grants, donations, and aid from other governments or international organizations, the rules are slightly different. Grants, donations, aid from other governments or international organizations. Revenue from transfers is recognized when the receiving entity has control over the assets. Often, transfers come with conditions. A condition is a requirement that the recipient must use the funds for a specific purpose or return them if they fail to do so. In this case, the revenue is not recognized immediately. Instead, a liability or an obligation is recorded until the conditions are met. For example, if an international agency gives Pakistan a grant to build 100 schools, the revenue is recognized as the schools are built, not when the cash is first received. The adoption of Ipsas 23 is fundamentally changing how public sector entities in Pakistan manage and report their finances. The Controller General of Accounts. The Auditor General of Pakistan, are leading this transition from the old cash-based system to a modern accrual-based one. Under the new system, government departments must identify non-exchange revenue streams and apply the principles of Ipsas 23. They can no longer simply wait for cash in bank accounts to record income. They must identify when they have a legal claim to resources. For instance, consider the Federal Board of Revenue, Pakistan's main tax agency. Previously judged on cash collected within the fiscal year, under Ipsas 23, the focus shifts. FBR must estimate and record tax based on economic activity income, earned by individuals, income earned by companies, sales made by businesses, even if tax returns aren't filed or cash isn't paid by year end. This gives a more accurate measure of revenue generated by the economy. This change requires system and process upgrades. Let's look at some simple, real-world examples to see how Ipsas 23 works in Pakistan. First, consider income tax. A salaried person in Lahore earns their monthly salary for June 2025. The taxable event is the earning of this income. Under Ipsas 23, the FBR recognizes part of that income tax in June 2025. The economic event occurred in June, not July, even if the employer pays the tax to FBR in July. The government has a legal claim to the tax. This gives a more accurate revenue picture for the fiscal year ending June 30th. Now let's take an example of general sales tax, or GST. A large retail store in Karachi sells a television on September 5th, 2025. The sale is the taxable event. The government has a claim to the GST at that moment. The store collects GST from the customer. The store later remits it to FBR, often by the 15th of the next month. Ipsas 23 says recognize GST revenue in September. Previously, revenue would be recorded in October when cash arrived. Transfers provide another clear illustration. The World Bank approves a $50 million grant to Pakistan for primary education. The agreement requires building 200 new primary schools. When Pakistan receives the $50 million, it cannot recognize it as revenue immediately. It records the cash as an asset. It records an equal liability called unearned revenue. As the government builds schools and meets the condition, it recognizes revenue. If it builds 20 schools, 10%, it recognizes $5 million. While the benefits of Ipsas 23 are clear, its implementation in Pakistan's public sector is not without significant challenges. The first major hurdle is the deep-rooted legacy of the cash-based accounting system. For decades, government accountants, auditors, and managers have been trained and have operated within a cash-based mindset. Shifting to an accrual-based system requires a massive cultural and intellectual change. This involves extensive training and capacity building for finance professionals and for all public officials who make decisions based on financial information. Resistance to change, both overt and passive, can slow down the reform process considerably. A second major challenge is the lack of robust and integrated information technology systems. Accrual accounting under Ipsas 23 requires tracking economic events, not just cash flows. Government departments need sophisticated IT systems to capture data on taxable events, sales income, fulfillment of grant conditions. To estimate income tax revenue, the FBR needs systems that link with employer data and other economic sources. Many existing government systems are fragmented, outdated, and not designed for the complexities of accrual accounting. The measurement and estimation of non-exchange revenue can be very complex. Ipsas 23 requires revenue to be recognized only if it can be measured reliably. How do you measure income tax from the informal sector? Overcoming the challenges of Ipsas 23 implementation requires a strategic and multifaceted approach. The first and most critical solution is a massive investment in human capital through comprehensive training and capacity building. This should not be limited to one-off workshops. It requires developing a continuous professional development program for all public finance officials, accountants, auditors, budget officers. The curriculum should focus on the practical application of accrual accounting principles. Use real-world case studies relevant to the Pakistani context. Certifications in public sector accounting, endorsed by regulatory bodies, could incentivize learning. Create a pool of qualified experts. Secondly, a phased and strategic upgrade of IT infrastructure is needed. Avoid a big bang overhaul. It's risky and expensive. A modular approach is more practical. Start by upgrading systems for the most significant revenue streams. GST, income tax, property tax. Design new systems to be interoperable for data sharing across departments and government levels. Invest in a centralized, integrated Ipsas compliant financial management information system as the long-term goal. The adoption of Ipsas 23 is about much more than just changing accounting rules. It represents a fundamental shift in public financial management philosophy. It moves the focus from tracking cash to understanding the true economic substance of government activities. This has profound implications for governance. When financial statements reflect all resources, the government claims, assets, and all its obligations, they enable an honest, comprehensive assessment of stewardship. Is the government living within its means? Is it financially sustainable? Enhanced transparency empowers citizens and civil society. Clear financial reports, comprehensive reports, and internationally accepted standards make public scrutiny possible. Citizens can ask informed questions about how tax revenues are generated and how they are used. That strengthens the social contract between state and citizens. In conclusion, Ipsas 23, revenue from non-exchange transactions, is not merely a technical accounting standard. It is a powerful catalyst for transforming Pakistan's public sector financial management. By providing clear and consistent rules for recognizing revenue from taxes and transfers, it replaces the outdated cash-based system with a modern accrual framework. This shift is fundamental. It ensures that government financial statements present a true and fair view of the resources a government controls, paving the way for a new era of clarity and reliability in public finance. By embracing Ipsas 23, Pakistan is not just adopting an accounting standard. It is making a firm commitment to good governance, fiscal responsibility, and a more transparent future for all its citizens.